All right, our final section here is to talk about the liquidity and solvency analysis portion of what we do. We're going to start with liquidity. So liquidity, if you recall, just simply refers to do you have enough cash or cash equivalents or instruments that can be turned into cash rather quickly to pay on your currently maturing liabilities, so those things that are maturing in the next year. If you have a lack of liquidity, if you have a low liquidity value, then there's a lot of things that could go wrong. If you're not able to cover your current liabilities, you're definitely not going to be able to cover your long-term liabilities in most instances. And these financial difficulties kind of tend to like snowball and stack up on each other. And eventually they do lead to bankruptcy. So there are three measures of liquidity that we look at, and we're going to discuss those really quickly here. Okay. So the first one is working capital. Working capital is pretty simple. It is essentially what is left of your assets after your liabilities are taken out. So it's current assets less your current liabilities. That gives you your working capital. So the larger your working capital is, the more positive it is. It's a good indicator of your liquidity, whether or not you're going to be able to pay current obligations on time. Okay. What it is not is not really a great measurement of liquidity. When you're comparing one company to another, because it's hard to compare something like Netflix to YouTube TV or YouTube Red or something like that, right? Netflix is just such a juggernaut that it's hard to compare those two using a simple working capital, their current assets minus current liabilities. So what we do is we use something called the current ratio. And this current ratio is the amount of current assets that you have available to you for every $1 of liabilities that you have, $1 of obligations, $1 of debt that you owe to somebody, right? So typically when you see a higher current ratio, the greater that company's liquidity, the greater your liquidity, the more chance the better your ability to pay these current liabilities are, right? So again, we use ratios to make these companies comparable to each other, right? If we use a ratio, a percentage, instead of a hard number, a hard dollar amount, we can make a comparison between Netflix and YouTube Red, right? We can say, oh, well, YouTube Red's is smaller, but they've got less liabilities and they've got more current assets, so it's easier for them to meet those liabilities, right? So let's say, for example, that you have a current ratio of 1.5. What that's telling you is for every dollar you have in liabilities, for every dollar you owe somebody else, you have $1.50 of current assets. Okay. And the way that we find that is we take our current assets in the numerator and we divide it by our current liabilities in the denominator. Notice, again, these are both balance sheet accounts, so there's no need to use an average here. The acid test ratio is our third. It's our third ratio that we're going to use. It's our third measure of liquidity that we'll talk about. So when you have the acid test ratio is a little different. It's like a more refined current ratio, okay? We're only going to look at what we consider to be quick assets, okay? These quick assets include your cash, your current investments, and your accounts receivable. We consider those to be the most liquid assets that we have. They're the easiest to turn to cash, so they're the only ones we're going to count as a quick asset. Please make note of that, okay? Make a note of that, highlight those, put stars by them, whatever you need to do, because you will need to know that for the exam, okay? When you're calculating your quick assets, you exclude all your other assets except for those cash, current investments, and accounts receivable. You don't include inventory. You don't include prepaid rent. You don't include prepaid insurance, those kinds of things. Those, while we like to consider them to be assets and they are resources we get to use, they do not turn to cash as quickly as those other three things. You may be asking why inventory. We consider our inventory to be a current asset. We do not consider it to be very liquid, though. Think about it. While we expect and want to sell that inventory in the next 12 months, there is no guarantee that we will. I mean, if you walk down, I know the Walmart that I go to has 2 entire aisles that are just clearance items. That is inventory they expected to sell that they haven't been able to sell at regular price, so they're having to sell it at a deep discount. That's why we don't include inventory in our quick asset calculation. Okay. What this acid test ratio does, like I said, it is kind of a more refined current ratio, right? We're going to get down to just what we have that we can quickly turn into cash. And that includes cash, current investments, and accounts receivable. It may provide you a better overall indication of the company's liquidity, okay? Because we're not including items that we don't think will turn to, that we don't think we're going to turn to cash, like prepaid rent. That's never going back as cash. Prepaid insurance, that's never going to be cash again. Those are just resources we're going to use in the company. They're not something we can use to pay off liabilities, right? So you take that cash, those current investments, and those accounts receivable, you add them together, and you divide by current liabilities, okay? Notice, again, these are all balance sheet accounts, so no need to create the average in the denominator. Just make a note of this. I included this in your note sheets. This is just something to be familiar with, okay? It's just a quick table that shows you what changes in the liquidity, what effect changes have on the liquidity ratios. The last thing, the absolute last thing we're going to talk about for Chapter 9 is solvency, okay? Solvency simply means, do you have the ability to make interest payments? Do you have the ability to pay back your debt as it comes due, okay? We're going to talk about 2 ratios that we use to measure financial risk that we relate to long-term liabilities. If you notice, the other 3 we talked about were for current, right? Those were all for current liabilities, current assets, that kind of thing. What we're going to talk about here with solvency is long-term. Okay, so the first one we're going to talk about is your debt to equity ratio. Okay. Like it says here, it's a measurement for solvency risk. What it's telling you is for every dollar in equity, every dollar that you own, every dollar in ownership that you have, how much do you have in debt? Okay, so one thing to note here, and it seems a little confusing, but just make a note of this, highlight this line. Often the ratio uses interest-bearing debt in the numerator instead of total liabilities. So you may see it presented where they tell you, what's your debt to equity ratio if you're only including interest-bearing debt? And when you include interest-bearing debt, it is bank loans, bonds, and leases in terms of this class, okay? However, it is totally fine if they don't say it to just use total liabilities divided by stockholders' equity. That is going to give you a ratio, a percentage of your ownership to your debt, okay? So the higher your debt to equity ratio, the higher your risk of bankruptcy is. The more at risk you are on defaulting on your liabilities, okay? So a higher debt to equity ratio is not good. We want it to be lower. The final one we're going to talk about is called times interest earned. When you say that out loud, it doesn't seem like it makes any sense, but really it is very literally defining what it is. It is how many times, based on your earnings, can you pay the interest expense for your company, okay? How many times over could the company pay their interest expense? One thing you're going to want to note for this particular numerator is that it is not simply net income. It is your earnings. It is what we consider to be your earnings, okay? So you're going to add back in your interest expense and you're going to add back in your tax expense, okay? So you take your net income plus your interest expense plus your tax expense, that equals your earnings. And you're going to divide that all by your interest expense, okay? That's going to give you the times interest earned ratio. That's going to tell you how many times over in the period could you pay the interest that you owe, okay? They like to see a higher number. The higher this number, the better off you are, okay? So again, note that the numerator for this ratio is not just net income. We have to add interest expense and tax expense back to the numerator so that we get that total earnings number, because we remove those expenses to get to net income, okay? We would have technically earned those amounts and been able to apply those amounts to the expenses, to that interest expense, okay? So, any questions about that, feel free to contact me. That is the end of Chapter 9. There is not a ton there. Chapter 9 is not incredibly lengthy. You can see just 4 videos here. So, any questions, feel free to contact me. I'm happy to answer them.